Welcome back to Finance Uncut. On today's episode, central bank doubles gold reserves. So central bank doubles gold reserves. Is it the Fed? Have a look at that picture from Jerome Powell. Do you think it's the Fed? Nah. So which central bank has doubled its gold reserves? Let's check it out. And coming in from Zero Hedge, Poland central bank to buy 100 tons of gold in 2022. In a time when institutions are increasingly shifting away from fiat currency and looking towards crypto, it is worth recalling that at least when it comes to central banks, there is no digital gold. There is just gold. To be sure, in a time of unprecedented economic and social turmoil, central bankers' appetite for gold continues to grow, providing a bright spot for the traditional haven as investors' interest ebbs. According to the World Gold Council, global reserves expanded 333.2 tons in the first half of 2021, which is 39% higher than the 5-year average for the period. Strong purchases by Thailand, Hungary, and Brazil stood out, with World Gold Council analyst Louise Street predicting that if central banks continue to buy at the levels seen recently, it will provide a supportive element for the market. And we've also seen India imports gone up, and German individuals, German retail investors accumulating the yellow metal as well. So when we look at this chart of Poland's gold reserves, their central bank governor in an interview said that they plan to increase their gold reserves by 100 tons next year to strengthen the country's financial stability. In the interview, he said that his plan will take effect when he becomes re-elected. His current term ends in middle of next year. He did say in that interview, though, that he does plan to introduce some $1,000 banknote, which is an indication that the gold may be coming only to offset even more currency printing down the line. Anyway, no matter his intentions, however, he has been good for Poland's gold reserves during his term. The amount of gold in reserves has more than doubled to 229 metric tons. And, he's saying that he's going to increase that with another 100 tons next year. And with this announcement from Poland that they made, remember back in March they announced they plan to buy at least 100 tons of gold over the coming years. Now they want to buy it all in 2022. Things are moving quickly. Pay attention. And Poland's central bank unexpectedly raised interest rates today to fight inflation. Are you really surprised they're stockpiling gold?
All right, second on the list, we got to hit those metals. We're not saying go put all your money in metals, but you should have some physical metals. Poland added 100 tons of gold, and they raised their interest rates. So you see the connection, higher interest rates, gold's a hedge. India added 91 tons of gold this year compared to 12 tons last year. German people keep stockpiling gold. Russia said they can help the energy crisis by hedging with gold. Do you see the narrative? The dollar, the currencies, the fiat. The more you print them, the more worthless they get. Metals are going up. Just be patient. Things don't happen overnight.
Central banks around the world have purchased record amounts of gold since the 2008 financial crisis. Do you think this is a coincidence? This is about national sovereignty. The oldest trick in the book is a gold revaluation. It's OG money, which still serves at the base level. And this is what Jim Rickards and Luke Groman are talking about, that the way out of this debt bubble that we're in is to revalue gold. But what the central banks and governments need, they need to get gold themselves first. And absolutely, this is true. You have a look at any chart, any of the data since 2008, central banks around the world have been purchasing record amounts of gold. Prior to that, you look at it, they weren't even interested in the yellow metal. So I put this report from the IMF called The Liquidation of Government Debt in the notes below, and you can read it in your own time. There's also another report which just escapes me that was done. It was a study done that shows when throughout history, different countries, when their debt to GDP is the level that we've got at the moment, how that debt to GDP or that debt is liquidated. And only one case over the last 100-odd years have been through a deflationary bust, and that's Japan. It's something like 80% or 90% of the time it's done through inflation, inflating the debt away, increasing the GDP to that debt number, so the debt to GDP figure is reduced. And I forget the report, but if I find it, I'll put it in the show notes below as well, and you can read that in your own time. But Austrian economist Daniel Lacaille tweeted this out: financial repression is most successful in liquidating debt when accompanied by inflation. And you still think that central planners will take decisive measures to curb inflationary pressures. And Russell Napier, who's been a 20-year plus deflationist, is now on the inflation bandwagon and is saying that we're going to see financial repression. He is a bit like Lynn Alden, where they're kind of comparing today to the 1940s. Similar debt numbers, similar debt to GDP numbers, all of that. Interest rates kept to the floor. So bondholders were just destroyed throughout that decade. Holding bonds, well, you lost, what was it, 60, 70% of your purchasing power by the end of the decade or something. And coming in from the Financial Times, the largest hedge fund in the world, Bridgewater, warns fighting inflation risks derailing economic recovery. The co-chief investment officer says central banks could find themselves powerless as rising energy prices rock markets. And you can see here, Bob Prince, co-chief investment officer at Bridgewater Associates, said the Federal Reserve's assertion that the current burst of inflation will prove transitory is likely to be challenged. Price pressures will be hard to fix, he said, given they are coming out of a shortage of resources that are in high demand as the global economy rebounds from pandemic lockdowns. And I would add all the new currency units that are being created. It's literally the definition of inflation, the Austrian definition of inflation. I've done a video on this, Inflation Explained. It is the increase or the expansion of the currency supply. However, prices are then determined by the other side of the equation, the supply of goods and services, or the demand for that money. So a demand for that currency. So when you have an increase in the currency supply and you have less goods and services, what do you think is going to happen to the prices? But what's interesting is now the big institutional investors, the big hedge funds, they're now waking up to the Fed and the central bank's BS around transitory. That this isn't going to go away, that this is going to be a problem for quite some time. And just in some conversations I've had with some institutional investors that were invested in gold and silver last year, and then moved into risk-on assets, have now started moving out of those risk-on assets and are considering moving back into gold and silver. Watch this space. And coming in from the Telegraph in the UK, the Bank of England warns of global markets crash if investors panic over inflation. Folks, we've got the largest hedge fund in the world. We've got institutional investors who are now starting to wake up to this whole inflation. Is it transitory? Is it not? And what does it mean for risk on assets? Things are about to start heating up, I think. And breaking news, UK's central bank chief economist warns of long-lasting inflation. And the IMF says prolonged input supply shortages, food and housing price pressures, currency depreciation could keep inflation elevated longer. Are they actually finally waking up, or have they been lying this whole time? UK consumer confidence sinks amid inflation fears, Bank of America survey says. What does this tell us? Stagflation. And coming in from Daniel Lacaille, JP Morgan warns of rising inflation in developed and emerging economies and negative impact on consumer staples sector. And here's a warning from Simon Mikhailovich. The Russian hyperinflation of the 1990s was 20 years in the making, as the economy stagnated and shortages built during the 1970s and 80s. Price controls kept inflation at zero, but once controls failed, Well, he's got a rocket taken off there. The Fed is on a similar path with 20 years of rates control. Once these controls fail, timber goes the currency.
Доллар пользовался очень большим доверием во всем мире. Это почти единственная была универсальная валюта мировая. Зачем-то Соединенные Штаты начали использовать долларовые расчеты как инструмент политической борьбы. Вводить ограничения на использование доллара. Своими руками начали пилить сук, на котором сидят. Но скоро они грохнутся. Доллары сокращаются как резервная валюта во многих государствах мира. Иран ограничивает в долларовых расчетах, на Россию вводит какие-то ограничения, на другие страны. Это подрывает доверие к доллару. Неужели это непонятно? Своими руками уничтожают доллар.
So before I share any other charts, this is a chart I forgot to put in a previous video. I think it was early last week, about the Indian gold demand in 2021, comparing it to 2020. And one of you actually commented, I can't remember who it was, said that that isn't a fair comparison because of what we went through in 2020. And, you know, and look, that's fair enough, but we're doing that comparison anyway. But you can see in this chart that 2021 that Indian gold imports have increased quite substantially. So with all the inflation that we've just seen, you know, the largest hedge fund in the world worried about inflation, the Bank of England worried about inflation, the IMF worried about inflation, institutional investors now worried about inflation, that they're now not believing the transitory story. This is a great chart from Crescat Capital that shows that gold, when just measuring it against CPI, should be close to $2,200. And I think most people actually think that, based on all sorts of metrics, that gold should be above that $2,000 mark. So what does that tell you? It tells you that it's undervalued, that it's cheap, that it is a cheap asset. And you wonder why central banks are buying like no tomorrow. What a great time to be buying gold. Now, once again, with the inflation, look, some people are warning of hyperinflation. I just can't get my head around that. I've never lived in it. I don't. I struggle. I honestly do. I struggle getting my head around hyperinflation. But I've shared charts before about the Weimar Germany period of hyperinflation, and there was that period where the mark actually appreciated against gold for a period of time, and it just so happens to be around 100 years ago, the same time period that we're experiencing, and there's warnings of hyperinflation in the years ahead. And you know, I keep coming back to the year 2023 is when I think gold and silver is going to kind of peak in this next bull market. And it's got nothing to do with this. It just coincides. It's just a coincidence that it coincides with, you know, Weimar Germany 100 years ago. You know, but we've got stagflation. It's already here. We've got stagflation. How bad is this stagflation going to get? How bad is the inflation going to get? And are we moving across to these left-wing policies, which is, you know, MMT? Well, we're a currency issuer, not a currency user. So we can just print whatever we want. We don't have to default on any debt. We can fund any program we want. People are saying that. People in Congress are saying that. People around the world are saying that. Now university economic professors are saying that. It's funny people don't learn from history, right? And that's fine. They're actually right. They're correct. They're true. You can print. You can fund anything you want. And as Alan Greenspan said, we can fund any program. We can meet all of our liabilities, but we can't promise to maintain the value of the currency. and that's the thing. So, you know, could this happen? Oh, of course it could. Anything could happen. Gold price rising $400 a month to as much as 2,000% per week. That's insane. It's insane. By the way, I'm not saying this is going to happen, folks. Like I said, I can't even get my head around this. Okay. I've got friends that lived in Yugoslavia during the 80s and 90s, and they tell me stories about it. I've got friends who've just come over in the last few years from Venezuela, and they tell me about what life is like, or what it was like in Venezuela. And yeah, I still can't get my head around that. So thanks to Katusa Research, where are we in this bull market? And according to them, we're here. So we are a long way yet in this bull market. We've got a lot more room to run in this bull market, and I believe so. And that's where I still think over the next couple of years into 2023, maybe 2024, maybe even earlier, we're going to see significant gains in the gold and silver market, which I'm quite excited about. But with that, with the macro environment, the inflationary environment, and investors, big hedge funds, banks, everyone now starting to be concerned about it, that it's not just transitory, we are going to see a move into gold and silver. And in my next video, I'm going to share a discussion that I had with an institutional investor a fortnight ago. I won't say anything more now. I'll save it for the next video. But you'll be, so you'll want to listen in to the next video. You'll want to hear the discussion that I had with this institutional investor. But with that, I believe the metals are going to do extremely well over the coming couple of years. And as you guys know on this channel, I'm a big investor in the gold, silver, mining, and exploration space. And at the moment, from the In Gold We Trust report, I've done videos on this before, but gold mining has never been more profitable than it is today. Never been more profitable. And yet at the same time, miners are still in this anti-bubble mode. So when I look at gold and silver miners and explorers, I'm just accumulating them. They are so on special. It's not funny. Some of my stocks that I'm accumulating at the moment, I believe, are about 300% undervalued. 300%. And that's a quite, I wouldn't say conservative estimate. I wouldn't say extreme either. I think it's a pretty average estimate. Some of my miners, producers, I believe that they're about 300% undervalued on extremely cheap multiples and no debt. I mean, the balance sheets have been incredible. They've really cleaned up their balance sheets. I've talked about that before, and I've shared in other videos the leverage that you get in that mining and exploration space on the underlying metal. So, once again, this isn't financial advice. This is just what I'm doing. I see the macro play. I see the inflationary decade ahead. And investors are now starting to wake up to the BS transitory talk. And we're going to see big investors, institutional investors, moving into this space. And I'll talk more about that in the next video. And we're going to see the devaluation of currency continue. And we're going to see the metals move higher. And therefore, we're going to get a lot of interest back in that mining and exploration space, where I think these will probably turn into a bubble. And that's where I'll probably look at selling my miners and explorers when they become a bubble. So anyway, that's just my opinion. Guys, if you like this video, please give us that thumbs up, hit that like button. Really do appreciate it. Love to see your thoughts and opinions in the comments below. Take care, everyone, and I'll see you again on another episode of Finance Uncut.